Alrighty guys, so in today's video, we're going to be back testing the ICT London Silver Bullet, right? So what I've got here, I've done the analysis already. I actually did record this once and there was no sound. So I've got the analysis here ready to go. For anyone that's like watching this as the first video, I'm just going to phrase this by saying the London Silver Bullet or any silver bullet is just a key time frame where you can actually execute a trade within. That's all it is, right? It's a 1 hour period. In terms of London session, it's 3 to 4 a.m. What are these times at the bottom? These are New York Standard Times, right? So I'm from Australia, but I still trade at the bottom on TradingView in New York time. So what it's pretty much saying is that during this time frame, there should be a trade, right? There should be liquidity to target. And that way you're not just, doing random, just entering at any random time. You're narrowing down your focus to around that time period. So have a look here. This was from yesterday. Look at these equal lows. Now, if you watch some other videos, you know that equal lows are a massive draw on liquidity. We have 1, 2, 3 drives up. That takes out this level of buy side, right, which is a previous day's high. Once we take that out, this is all within the silver bullet. I myself actually executed this trade, right? There's a breaker block here. There's an order block here. We return up into this zone and then we sell off, right? Where do you target? This sell side, low hanging fruit, and this level of sell side here too, right? So you can see that during this window, the market offers you opportunities, right? Let's assume you miss that. Price comes down, it sweeps this low. This is an Asian session liquidity low. After sweeping that, do we have a market structure shift? Yes, that's your market structure shift right here. Do we return to a fair value gap? Yes. So one way to do the silver bullet is rate of liquidity, market structure shift, return to a fair value gap. And that's what you're seeing down here. Another way is up here, which is rate of liquidity, market structure shift, and return to a order block or a breaker. So the returning is up to you what you want to enter from. So there's your market structure shift and you return back in here, right? And this is all in the 1 minute time frame. So again, 1 minute time frame, you're trusting that time is going to do the heavy lifting, and you look at key liquidity points. So previous day's highs, previous sessions lows, right? So that's the first we'll talk about. Let's talk about this next one, right? And this was on the Monday. So have a little bit of a look here, right? Silver bullet. We push up here. We do take out these, 2 points of low resistance liquidity, right? We sweep that. We come up, we sweep this. What is this high? This is an Asian session high. Again, Asian session for me is 7 to 12 at the bottom here, but it could be 6 to 12 for you. Whatever you want to use, that's completely fine. So you utilize whatever you want to use. And that's kind of what we're looking at here. So there's your, your buy side liquidity. We sweep that. Now, what is this entry model? This entry model here during the silver bullet, rate of liquidity, inversion fair value gap, entry off return. So in this case, notice how on the 1 minute, you don't see a market structure shift. Maybe until you get down here, you do, but you don't see a really clear one there. So using this entry model, but it still works, right? So is this method patched? It's not. Are there going to be days where it doesn't, set up nicely? Yes. But at the end of the day, there's always going to be an opportunity throughout the week. Guaranteed, more than not, the silver bullet will provide opportunities either just after or just before. So even though that's your window there of trading, I still accept anything just after or just before as a silver bullet trade, because you let the silver bullet raid liquidity or do something, and then you execute as a result of that. So you can see entry here, we absolutely sell off. We take out all that liquidity. These liquidity points were also generated in that silver bullet. So that's 2 days of back testing there. This third one here, this is NFP news day. On red folder news days, especially NFP, look at the London session. It's so choppy. There's going to be nothing there, but it is expected because all you're doing here is generating liquidity during the silver bullet to be taken out later on. So no trading day for a lot of people, or if you do trade, you're looking for small scalps because the market sometimes is a bit weird on those NFP days. Next day, have a look at this one. That there's your silver bullet, right? So price comes down, 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 down. We raid liquidity here. Right? This is your raid. This is your market structure shift, and we return back into this bullish gap. What I've also noted here is on the 1 hour time frame, right? There's an imbalance. there's an imbalance, right? So from this candle's high to this candle's low, this black line is a halfway point, and look how we react off that. So if you were trading on the 1 minute and you see this reaction, right? So you see this reaction right here. Now you're just waiting for price action to do something important. So you play price out. At this point, we've inversed this fair value gap. I'm waiting for a retracement. Or you could have entered straight away here from the inversion. And then when price comes back down, here's your second entry. Where do you target? You target all this buy side liquidity resting above these highs. Or you can go for a fixed, 1 to 2, 1 to 1.5, whatever kind of risk to reward you want. Doesn't mean you can't hold after the silver bullet. Like you could still be holding here if you wanted to, right? But you want to see the setup form in this time frame. That's the whole idea of the silver bullet. And this is like another example where you've got a rate of liquidity, a market structure shift, and then a return to an imbalance, right? So that's a really clear example there. The next day, let's go back and see this one here. There's nothing good. There's nothing good. Look, it's all choppy, choppy, choppy. And why might that be? Because we've had a big run down in the end of Asian session, right? When you have a big expansion in Asian, sometimes the London Open and the start can be messy. So you've got to wait a bit longer. So you can see here, after 5 o'clock, we do get some nice price delivery. But during that London Open session, the price is like trying to decide what it wants to do. So you won't always get clean price action, but it's a matter of identifying why the price action should be clear, why it might not be, and then executing as a result. So next day here for us guys, we've got the 3 drives pattern. So again, this is silver bullet window, 1, 2, 3 drives. We raid these highs here. These are Asian session highs. We also sweep this high here, which is a previous day high. And then after that, look at this. We've got a SIBI that you can enter from short. Now, on the 30-second, 2-minute time frame, it could look a bit different, right? But if you don't have access to the 2-minute or the 30-second, this is what it's going to look like. So if you have high conviction, right, you could enter right from here. Are you waiting for a market structure shift? Well, not really, but on the 30-second, you might see that. So that's kind of why it's up to you based on your rules. So you might get a rate of liquidity and you might just get an imbalance to enter from, and you might need to use the 30-second or the 2-minute or another time frame to see things on. So it's up to the individual how you execute a trade during the silver bullet. But let's say you didn't like that one. All right, let's do this one. This is your low. We sweep that, right? Look, we sweep that, we sweep that, we sweep that. We swept Asian liquidity. We're still on the silver bullet. We inverse this fair value gap, and we create a balanced price range, right? Heaps of sellers here. The buyers balance that out. Look what I'm marking out here. This is your balanced price range, or one of the balanced price ranges. So in this case, what are you entering off? You're entering off a rate of liquidity, a market structure shift above this high or above these highs, and you're entering off a return to a BPR or a bullish fair value gap, because there is one technically here. Why doesn't price go down any further? Because this is a balanced price range. This imbalance is balanced here, right? This is all balanced. So you can see here we accumulate there. That's good. We're accumulating more longs. This leaves more liquidity at the top to target, and then price pushes up and takes out that 3 drive. So again, just a few examples, and I've got more here I'll show you guys as to how you can actually execute using the the silver bullet entry. So here's another one. There's your silver bullet. Rate of liquidity, market structure shift, return to an imbalance. So you're trusting time. Why doesn't it go this low? It will eventually, but it's returning to this imbalance here. So as long as you rate liquidity and you feel an imbalance, that's the highest probability trades then have a reversal, right? And then use time as, I guess, the heavy lifting model. So all these buy side points, these are good liquidity targets. And you can see how we move there. We return to that imbalance, stop loss below the low, and we push up. So again, if you're always looking to enter off a fair value gap, you might not always get entries, but you will get entries a lot of the time. So that's where I started to incorporate inverted fair value gaps, balanced price ranges, and all those other fancy things. But you don't necessarily need them, right? Here's another example. Rate of liquidity, Asian session liquidity. Is there a market structure shift? Not really until you get to here. By that point, it's too late. So in this case, you're using an inversion fair value gap price returning to that right here and this busy to then execute a trade. But you still got the rate of liquidity. The rate of liquidity is important in my opinion, because if you're going to have a reversal, you should have rate of liquidity, and that will prime the market because it's taking out stop losses to then move in the other direction. This high, all these highs, all low resistance. So we trade through there quite aggressively. So again, the silver bullet model does work, guys. Have a look at this one. We talked about the 3 drives on the upside. This is now on the downside. Same process though, same process. 1 drive, 2 drives, 3 drives. We rate liquidity right here. We have a market structure shift right here, and we return here. Now, what is this? What is this? You might be asking, what is this, Ruben? All right, let me just go back. If you have a market structure shift and you're like, wait a sec, there's no imbalances, that is when I go to slightly higher time frames. There's your 2-minute imbalance. There's your 2-minute inversion. So again, entry here should go at least below 2 to 3 PD rays, right? And then you can target whatever you need to, which is this high. The risk to reward, yes, it is important, but aim for liquidity targets, right? Aim for the low-hanging fruit. And if you want to hold a partial, but low-hanging fruit targets should get taken, even if your bias is wrong. Like, of course, you could take it all the way to here and you still get your profits. But again, you don't have to. You don't have to. And that's probably like an important thing to mention for anyone looking at, the silver bullet. Let's do some more. So let's go here, which is 3 o'clock. So 3 o'clock, roughly about there. 4 o'clock, roughly about here. So what happens here? We just shoot up, we shoot up. Do we take out any liquidity? Look how far back we're going. We're going back to this high and this high. So we do take out liquidity. We do rate liquidity. Is there a market structure shift? Well, yes, right? Below this low here, that's your shift. How do you execute a trade off this? Well, this is an order block. This here is an inversion fair value gap. So you can wait for retracement back into this inversion and go short from there. Stop above this swing high. Targeting any imbalance. Like there's an imbalance here, an imbalance here. You could target a 1 to 2, whatever you need to get. And you can see that kind of works out, right? Price then comes back down into equilibrium of the previous range. So have a look at this one. This low to this high. We come down into optimal trade entry. We tap below equilibrium, and then we start to have a reversal. So again, you could take the trade back up if you wanted to, but you got to just work with what the market gives you, right? So it's not always going to be, perfect, but more than not, it's going to give you an opportunity. This one here, 3 to 4, is there anything good? No. So look at the price action. It's just sideways. You might as well leave it because often the price action will be cleaner later on in the session. So if you're still there, you can take advantage of it then. And let's do one more. Let's do one more. So down here, look at this. This is your original accumulation. Sell side, buy side of the curve, right? We come down, we raid liquidity. This is your market structure shift here. But look at this. We don't get an entry until all the way up here. In my opinion, that's too far up. So you got to look for inversion fair value gaps, right, as a, or you could wait for a retracement here if you really wanted to. This fair value gap could be your entry. These candles here are a breaker block. So you could use a unicorn entry model. But the thing is, your stop, there's going to be imbalances here. It has to be quite wide to actually mitigate that or below this breaker. So I like an entry down here maybe, and then maybe an entry up here. So that's kind of how I see it. But you can see that's between 3 and 4. So hopefully you guys got something from this video. If you've got any questions, leave them in the comments below. And until next time, I'll talk to you guys then.